Welcome back. So today we're putting on our equity analyst hats to look at the source material for NorthWestern Energy Group, ticker symbol NWE. It's really easy to just look at a stock ticker and accept that flashing price on the screen as the absolute truth. But as we all know, price is what you pay and value is what you actually get. In this explainer, we're going to tune out the daily market noise and dig deep into their recent filings to calculate the true underlying intrinsic value of the company. All right, let's just dive right in.
Right now, the market has slapped a $71.93 price tag on NWE. But is it actually a fair price? Think of this valuation like a bit of a financial detective story. We absolutely can't just take the market's word for it. Instead, we're going to use a technique called triangulation. We'll take the data straight from the reports and stress test that $71 price tag using a really rigorous valuation framework to see what's actually hiding beneath the surface.
Here is our quick plan of attack for the analysis. 1. The valuation mystery begins. 2. Absolute models covering future cash. 3. Relative models looking at neighborhood comps. 4. Asset models focusing on the balance sheet. And 5. Synthesizing intrinsic value. Let's get to it.
Part 1. The valuation mystery begins.
Now, right off the bat, there is a massive, glaring contradiction sitting right at the top of their financials. Over the trailing 12 months, NorthWestern Energy reported a really healthy net income of over $181 million. Looks great, right? But then you look at their free cash flow. It's sitting at negative $130 million. That is a wild discrepancy. A company can easily show accounting profits on paper, sure, but cash is what actually pays the dividends and funds growth. This massive negative cash flow is a huge clue for us, and honestly, it's going to heavily dictate which valuation models we can actually rely on today.
Moving right along to Part 2. Absolute models, future cash under the microscope.
Normally, the absolute gold standard of valuation is the discounted cash flow, or DCF model. But, well, you can't discount cash that doesn't exist. With that negative $130 million in free cash flow we just talked about, projecting out a DCF right now would require some major, highly speculative assumptions about exactly when they'll turn cash flow positive. It's just too fragile, so we have to pivot. We're shifting over to the dividend discount model, or DDM. This model is incredibly stable for NWE, mainly because the source data shows they have successfully increased their dividend for 21 consecutive years. That is a track record we can actually work with.
So let's actually walk through the DDM logic step by step using the data. Step 1, we extract the current dividend yield, which is sitting at a pretty solid 3.73%. Step 2, we need a growth rate. The filings tell us their trailing 12-month dividend growth rate is exactly 1.51%. Now for step 3, we have to discount all of this back to the present value. Since the provided documents lack an explicit weighted average cost of capital, we have to make a sensible assumption as analysts. So we're using a 6% cost of equity, which is a very standard conservative baseline for a mature utility company like this one.
When we factor in the specific inputs and rely on the direct calculations provided in our source data for an earnings-based absolute valuation, we hit a calculated fair value price of exactly $54.19. This EPS fair value is essentially acting as our proxy for a residual income absolute model. But just take a second to notice how far away $54.19 is from that current trading price of nearly $72. Yeah, that is our very first major red flag.
All right, Part 3. Relative models, neighborhood comps.
If you're buying a house, you obviously want to know what the house next door sold for, right? Well, in equity valuation, we use multiples to do basically the same thing. Looking at the data, NWE is trading at a trailing price-to-earnings ratio of 24.47, a forward PE of 18.32, and an enterprise value-to-EBITDA ratio of 13.46. Now, the source material doesn't explicitly list specific competitors, but if we assume a baseline of standard mature utility peers, think of an Xcel Energy or Duke Energy, a PE approaching 25 is running incredibly hot for a slow-growth utility.
And honestly, this next point illustrates things even better. We don't just want to compare them to the neighborhood, we need to compare them to themselves. The data explicitly points out that NWE's current PE ratio of 24.47 is a whopping 38.67% higher than its own 3-year historical average of 17.64. So, from a purely relative perspective, the market is currently paying a massive premium for this stock compared to its own recent historical norm. That strongly implies the true intrinsic value really should be quite a bit lower.
Moving to Part 4. Asset models, the balance sheet breakdown.
Now we're going to calculate the net asset value, or NAV. Simply put, This just means taking the fair market value of everything the company owns, subtracting absolutely everything it owes, and then dividing that number by the total shares outstanding. We are essentially virtually liquidating the company right here, stripping it down to its bare bones to find its absolute floor value.
Using the metrics provided in the filings, we can actually mathematically back into this number. We already know the current stock price is $71.93, and the data gives us a price-to-book ratio of 1.53. So if we just divide the current price by that price-to-book ratio, we get the actual book value of equity per share. $71.93 divided by 1.53 equals exactly $47.01. So if you stripped NorthWestern Energy completely down to just its net assets, it's worth roughly $47 a share.
And finally, Part 5. Synthesizing Intrinsic Value.
Let's bring all this detective work together to summarize our triangulation. Our absolute valuation, which was driven by EPS fair value, gives us $54.19. Our relative valuation shows the stock is heavily overvalued compared to its own historical PE average, and our asset valuation, the NAV, establishes a really solid baseline floor of $47.01 per share.
So the absolutely crucial point is when we compare these numbers side by side. Think about our rigorously tested intrinsic values, the $47 NAV and the $54 absolute fair value. Now contrast that with the current market price of nearly $72. Both of our strictly data-driven models fall significantly short of what the market is currently demanding you pay for this stock. Let's take a second to acknowledge the strengths and weaknesses of our overall approach here. Like we said earlier, the traditional DCF was totally unusable because of those negative cash flows. The NAV gives us a rock-solid floor, but to be fair, it completely ignores any potential future growth. That leaves the absolute EPS fair value model at $54.19 as our single most reliable estimate. It accounts for their actual earnings power and respects their long, stable history as a dividend-paying utility, even when their current cash flows are honestly a bit of a mess.
And that brings us right to our final verdict for this explainer. The data strictly tells us that NorthWestern Energy exhibits a negative 32.73% margin of safety based on its EPS fair value. Simply put, at $71.93, this stock is mathematically overvalued. For a value investor looking for a bargain, or honestly even just a fair deal, the source data strongly suggests NWE is currently a trap, not a steal.
But I want to leave you with this final thought to chew on. Our models, no matter how rigorous or perfectly calculated, are based on fundamental math and historical data. But that current market price of $72? That's based on real humans buying and selling right now, perhaps pricing in a wave of optimism that the raw data just doesn't reflect yet. It is the eternal battle between mathematical fundamentals and human market psychology. When the math says a stock is worth $54, but the crowd screams it's worth $72, which one do you trust? Think about that and keep learning.